Topic explains the importance of stakeholders and environmental, social, and governance (ESG) factors in corporate decision-making and investment analysis. Stakeholders are individuals or groups affected by a company's activities, including shareholders, employees, customers, suppliers, creditors, regulators, and local communities. Corporations must balance the interests of these groups while pursuing profitability and long-term value creation. ESG considerations have become increasingly important because investors, regulators, and consumers now expect firms to operate responsibly and sustainably. Understanding stakeholder relationships and ESG risks helps analysts evaluate corporate resilience, strategic positioning, operational quality, and the long-term sustainability of financial performance. Shareholders are among the most important stakeholders because they provide equity capital and bear residual business risk. Shareholders expect management to maximize firm value through efficient operations, sound strategy, and effective governance. However, short-term profit maximization may sometimes conflict with the interests of other stakeholders or long-term sustainability objectives. Corporate managers therefore must balance shareholder expectations with broader social and operational responsibilities. Investors increasingly recognize that firms focusing solely on short-term earnings may expose themselves to regulatory, reputational, or operational risks. ESG integration encourages companies to adopt longer-term strategic perspectives that support sustainable profitability, improve stakeholder trust, and enhance overall enterprise value over time. Employees are another critical stakeholder group because human capital significantly influences productivity, innovation, and operational performance. Companies that invest in employee training, workplace safety, fair compensation, and diversity often experience higher morale, stronger retention, and improved efficiency. Poor labor practices, unsafe working conditions, or discrimination can damage reputation, increase legal risk, and reduce productivity. The social component of ESG analysis evaluates how firms manage workforce relationships, labor standards, employee well-being, and human rights concerns. Analysts increasingly consider these factors because strong workforce management may contribute to competitive advantage, operational resilience, and sustainable long-term growth in knowledge-intensive and service-oriented industries. Customers and suppliers also play essential roles in corporate success and ESG evaluation. Companies depend on customer trust, product quality, and reliable supply chains to maintain revenues and competitive positioning. Ethical business practices, product safety, data privacy, and transparent communication influence customer loyalty and brand reputation. On the supplier side, firms may face ESG risks related to labor standards, environmental practices, or geopolitical instability within supply chains. Disruptions or unethical behavior among suppliers can damage corporate reputation and operational efficiency. Investors therefore analyze supply chain management and customer relationships carefully because they affect business continuity, profitability, and long-term strategic sustainability across global industries. Environmental factors examine how corporate activities affect natural resources and ecosystems. Key environmental considerations include carbon emissions, energy usage, water consumption, waste management, pollution control, and climate-related risks. Companies operating in environmentally sensitive industries may face stricter regulation, rising compliance costs, or reputational challenges if sustainability concerns are poorly managed. Climate change also creates physical and transition risks affecting operations, supply chains, and asset values. Firms adopting environmentally responsible practices may improve efficiency, strengthen stakeholder relationships, and reduce long-term regulatory risk. Investors increasingly incorporate environmental analysis into valuation models because sustainability performance can influence future profitability and operational resilience significantly. Governance factors focus on how corporations are directed and controlled. Strong governance promotes accountability, transparency, ethical conduct, and effective oversight of management decisions. Governance analysis evaluates board independence, executive compensation, shareholder rights, internal controls, risk management, and financial reporting quality. Weak governance may increase the likelihood of fraud, excessive risk-taking, conflicts of interest, or poor strategic decisions. Corporate scandals and governance failures have demonstrated how weak oversight can destroy shareholder value and damage stakeholder confidence. Investors therefore consider governance quality a critical component of risk analysis because effective governance supports long-term financial stability, strategic discipline, and responsible corporate leadership. The topic also explains how ESG factors influence investment analysis and portfolio management. ESG risks can affect revenue growth, operating costs, legal liabilities, access to financing, and overall market valuation. Companies with strong ESG performance may benefit from lower capital costs, improved reputation, stronger customer loyalty, and reduced regulatory exposure. Conversely, firms with weak ESG practices may face litigation, operational disruption, reputational damage, or declining investor confidence. Institutional investors increasingly integrate ESG considerations into investment processes to identify risks and opportunities not fully reflected in traditional financial analysis. ESG integration therefore enhances long-term risk assessment and supports more sustainable investment decision-making. Overall, topic demonstrates that stakeholder management and ESG analysis are essential components of modern corporate and investment evaluation. Companies operate within broader economic, social, and environmental systems where stakeholder relationships directly influence long-term performance and risk exposure. Effective management of employees, customers, suppliers, communities, and environmental impacts can strengthen operational resilience and support sustainable profitability. Strong governance practices further improve accountability and investor confidence.